Hi, welcome to Element 4.6. This is the continuation from Unit 4, the traditional industry and how it changes into smart industry. So this is the last part of the industry that we're going to look at, which is finance. For this video, we're going to look at the challenges of traditional finance, which sits in after looking at manufacturing and retail. And the next video following after this will be smart finance and how we can incorporate and look into cases of smart finance, especially from China. Now, what we're going to be covering in this video, we're going to recognize and recall some of the traditional industry limitations, challenges and opportunities for traditional industries in the digital economy. And we're going to analyze the challenges and opportunities of digital transformation of traditional industries within the country. So, in introduction and fundamental roles of traditional finance, we first need to understand what it is. Finance is basically the utilization and management of money to perform actions such as investing, lending, budgeting, saving, and forecasting. Finance can be broken down very broadly into three key areas, which is personal finance, business and corporate finance, and government and public finance. The fundamentals of personal finance include the process of analyzing, managing, and planning personal financial matters and activities. Some of these core considerations can include your budgeting, your expenses, your incomes, your savings, your investments, and also security and protection. Think about how you've been using online banking or any banking financial things that you've been doing all this while. Business and corporate finance entails two important things. It relates to matters and activities that relates to daily operations as well as capital structure of a business venture. It also refers to the tools and the processes used to procure, interpret, react, and report financial data. In most instances, the role of business and corporate finance is to maximize business value and profitability via the planning and management of organization and financial resources, whilst simultaneously mitigating whatever risk that the investments will bring. The common activities undertaken in business and corporate finance are usually this four. Firstly, is operational activities. That means supporting the day-to-day activities that keep the business operational. That also includes managing and tracking expenditure, staff, rent, salaries, utility bills, purchasing office equipment, transport, market spend, and etc. It also means managing and tracking incomes, like for instance, invoicing customers, receiving dividends, and etc. That also includes managing and tracking financial performance of projects. Next is budgeting and investing. That means the performance of which ventures and assets to invest time and resources in that will earn the highest possible return by factoring the risk in. So you use tools for analyzing cash flows, analyzing investments, identifying which are the best capital expenditures. Financial modelings are used to identify and manage and compare the impact of investments and activities. Now, commonly used are net present values and the investment rate of return. Thirdly, capital financing. This is the role of the business and corporate finance to manage how best to finance operations and investments. That means by balancing the use of debt and equity such that the capital structure of the business is optimized. For example, WACC is minimized. And fourthly is dividends and returning capitals to investors, making decisions whether to retain the profits to fund future operations or to distribute them to shareholders by conducting or buy back the shares. In public finance, there are several common activities undertaken. First one is tax collection. That means that governments use tax as their main revenue source, and sales and, like for instance, sales and revenue taxes, property taxes, real estate taxes, and duties. This also can come from personal and corporate income tax. Second is expenditure. All real government expenditures, infrastructures, educational and social programs, and etc. the like, can be seen as a form of wealth redistribution back to the society with the intention of benefiting society as a whole. Most commonly are insurance, pensions, infrastructures, defense, education, healthcare, roads, and other infrastructure that you can think of. Thirdly is budgeting. Fiscal budgeting for a government is important because they plan it over the year, over the upcoming fiscal year. And finally is debt management. The issuing of national debt to fund expenditures usually occurs in instances of national deficits, but also sometimes occurs during surplus. Usually, it is the role of the National Treasury or the Reserve Bank to issue such a debt. Now, what are the key challenges for small businesses and entrepreneurs when it comes to finance? Firstly is the integration of various payment systems and methods into operations. And then you can also see that there are many other things as well, like payment inefficiencies, inconsistent cash flow, access to financial education and literacy, tracking expenses, global finance, lack of access to capital, managing money, keeping it safe, time-intensive nature, sound financial management, and tracking of financial performances. So take some time to go through this list and read each and every one of this so that you at least understand a bit about what are some of the key challenges for especially local SMEs when it comes to finance. So I'm going to go through with you that example about how traditional finance is not inclusive. Now, in its broader sense, when basic financial services are about wealth creation, income smoothing, and trust. Income smoothing is the utilization of lending and saving to smooth out the times between a person or a business having money or not. So for example, if let's say it is used for student entering a university or a company startup phase, what we use is what we call a loan. Now this loan helps the lender lay the foundation for future income. If let's say the person wants to start up a business, as does learning to manage the repayment of the loan is also important. Saving, however, is the opposite of lending. Since saving for retirement is about ensuring access to money when one is no longer working, so without the loans and savings, it would be definitely impossible for most individuals or any group to buy homes or to gain higher education or to start businesses. Therefore, lending and saving are at the core business function of banks. As banks are important financial infrastructure providers in all countries, they are typically heavily regulated and carefully monitored. Banks must apply rigid procedures for assessing a customer's likelihood of default before issuing any credit and transaction, such as payments between different banks. This leads to high transaction costs, naturally causing banks and other traditional financial services institutions to prefer larger customers and transactions, which doesn't really include the smaller players in the industry. So in many developing countries, this means that accessing financial services such as bank is not always a possibility. People in these situations are often referred to as the unbanked, underbanked, or non-financially included. Limited access ranges from not having a bank account sometimes, which means that all their financial transactions are performed using cash, to having basic financial services, but no access to student or housing loans or funds for starting up a business. In general, the problem is greater in poorest and most underdeveloped countries and regions in the world. But this is also a problem in rich countries, when the World Economic Forum reported that due to a number of factors, such as the aftermath of financial crisis and the introduction of new regulations, particularly Basel II in recent years, bank lending to small and medium-sized enterprises, the SMEs, was reduced both in the US and the Eurozone. You think about the financial crisis that has happened in 2008, and this crash also meant a lot of the subprime rates in US were deducted, and therefore it landed a lot of people in unemployment and not enough money to pay their housing loans. Now, you look at the ownership of store or value transactions accounts across selected countries. China, in the red, sits at about 79%, which means that 79% of adults aged 15 and above reporting ownership of store or value transaction account. Now, that is actually a very, very good number, but that also means that there is a percentage of the country that does not own a place where they can store their money, which means that a basic financial service of having somewhere to store your money is not given to at least about 21% of the population, and that is a high level of people. Now, traditional finance is also not inclusive by looking at borrowing from each of these countries. Now, this graph shows you the comparison of borrowing in different sectors like regulated financial institution, family friends, health, and also for startup and business, which is quite of the lowest. In comparison between China and the G20 high income earners, the G20 middle income earners, the Eastern Partnership low middle income earners like Azerbaijan, Moldova, and also the other states that belong to that region. Yeah. So when you see this, you notice that citizens of a lower income country tend to rely more heavily on friends and family, because this is particularly true for citizens in rural areas, because they would definitely want to start up their business, but they cannot have access to a bank. So low income earners and low skilled workers will tend to. Now, you have to understand that borrowing or any sort of financing is basic necessity for small businesses. This is because small firms in low middle income countries have the least access to any financial support or services, where the banks are not fully equipped to give out loans, nor to give out good loans to small businesses to help them to achieve something. You notice also in this graph, you see that large firms do most of the borrowing, whereas the smaller ones don't have that much borrowing at all. And if you see again in the Eastern Partnership countries, they do the most of the borrowing, especially when it comes to small firms as well. It accounts for about 32% to 33%. So, having noted all that, I want you to tell me now, imagine if you were in a small country with low middle income earner, low to middle to low income. I want you to tell me, what is the biggest problem do you face when you do financing online? You don't have to go far. You just think about Malaysia and think about what are the challenges that you face when you face traditional finance, especially getting a loan, or even filling out forms, or even understanding some of the intricacies behind financing. You can go to the Padlet by scanning this QR code, or going to the Padlet straight away from this URL with the password DECN2014. So that concludes some of the challenges about traditional finance. And you've seen what finance is all about, and you also see what are some of the problems that small businesses face when it comes to traditional finance, which spurs the need for smart finance in our final video that I will talk to you about in the transformation of traditional industry to smart industry. Thank you.